We have to begin with the big issue. The Fed poised to join the global easing cycle.
We see the Fed lining up to do a rate cut.
A rate cut this week.
Both the Federal Reserve,
the Fed,
and potentially the ECB.
Followed by the ECB.
The Fed goes in July. We think the ECB goes in September.
Everybody's doing the same thing.
You've got global easing.
Policy easing on a global basis.
Global easing cycle.
Global coordinated central bank easing party.
No central banker wants to be left behind. South Korea, South Africa recently.
We're looking for Indonesia and Philippines, for example, to cut interest rates one more time.
The RBI, Reserve Bank of India.
And Malaysia.
The RBA has cut twice. Russia, you name it, Ukraine, on and on.
You've got soft central banks everywhere.
Everybody's cutting rates right now.
So the key question, will it be enough? Joining me around the table to answer that, Troy Gayeski of SkyBridge Capital, Michael Shaoul of Marketfield Asset Management, and Peter Tchir of Academy Securities. Peter, let's begin with you. Your thoughts, will it be enough?
Yeah, I think it's going to be enough, and I think what people have to really focus on is the Fed's reaction function has changed. They're going to be slow to ever tighten, they're going to be quick to ease. I think that's going to be the important message. It's not how much they cut or what the exact message is, it's that they are now really going to push this economy along.
What do you think, Troy?
Well, I think from here out, they're going to be data dependent. So we think 25 basis points, it was kind of wild to watch markets. You remember at the end of June, there was a brief period where markets were pricing in 3 Fed rate cuts for the balance of this year. And it really wasn't supported by the data. So we think 25 coming up. Then they're going to be data dependent. We've already seen economic growth come in stronger than expectations. Clearly, the consumer is in excellent shape. And so from here, we're probably going to need another growth shock. It could come from policy. It could come from an escalation of trade for them to move more aggressively.
Troy, some people might say if they were truly data dependent, why are they looking at cutting interest rates this Wednesday?
Well, so part of that is an admission that the Phillips curve was even flatter than they thought, right? You step back. Powell's Fed expected inflation to come in stronger. It never materialized. So it's partly an admission that they were wrong for the December hike. Secondarily, inflation did roll over, and let's face it, growth in Europe has been a train wreck, and China's been slowing pretty aggressively. So they have plenty of cover to cut once, but our point is from here, if they're going to cut again, things are going to have to deteriorate further.
Your thoughts, Michael?
I think it's a different kind of central banking. Under sort of conventional terms, there's absolutely no reason to cut rates. The economy's okay. It's been a little bit volatile, but really nothing of the sort that you would expect to see at the beginning of a cutting cycle. And financial conditions, frankly, are great domestically and are okay globally. So this is something different. I think we are crossing a Rubicon. And I don't think central banking and the Fed is ever quite going to be the same, again.
In what way, Michael? In what way are things changing?
Because I think they're trying to sort of micro-control things in a way that they haven't historically. If you went back to the Greenspan Fed, his idea was, look, you allowed things to sort of get along. When things kind of got out of control, you tightened. When they blew up, you mopped it up. 20 years later, we're 180 degrees away from that. You went through Bernanke and Yellen, which were like the initial, the initial changes, but really, there's no crisis, even globally. There's no major economy in a recession, or even frankly close to one. And yet we are in a global synchronized, there may be like no actual control, there may be no cross agreement between central banks, but we're in a global easing cycle, which is as much as we saw in the Euro crisis.